Welcome to The Explainer. Today, we're cracking open a comprehensive 15-page financial deep dive into India's absolute adhesive monopoly, Pidilite Industries. We're going to extract the core fundamental insights from this stress-free investing analysis to see exactly what makes this specialty chemical giant tick. But before we jump right into the numbers, we need to establish our baseline and set the ground rules. Welcome to Stress-Free Investing Analysis. Personal notes. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. All right, here's our roadmap for today. We're covering 1. The Fevicol monopoly. 2. Flawless financial health. 3. Passing the forensic tests. 4. The raw material threat. 5. 3 scenario valuation. And finally, 6. The final verdict. Let's get into it. Okay, let's dive into this. Section 1. The Fevicol monopoly, understanding the moat. Think about Pidilite for a second. We're talking about unparalleled market dominance built methodically over 65 years. I mean, their flagship brand, Fevicol, it's so deeply embedded in the consumer mindset that Fevicol ka jod is literally a cultural expression for an unbreakable bond. But hey, how does that actually translate to cash? Well, Pidilite generates about 80% of its revenue from the consumer and bazaar segment, and the remaining 20% from B2B operations. The absolutely crucial takeaway here is that up to 75% of their total revenue comes from recurring repair, renovation, and maintenance demand. So they're effectively insulated from slowdowns in new construction. Pretty smart, right? That kind of structural resilience is protected by what we call an unbreakable moat. They command a staggering market share. We're talking over 70% in branded woodworking adhesives. They push all this through a colossal network of more than 7,000 distributors and 75,000 retailers, giving them incredibly deep reach into semi-urban and rural markets. But honestly, their true genius? It's the carpenter ecosystem. Pidilite has spent literal decades training the actual carpenters and plumbers who use their products. It creates this irreplaceable demand pull model where the end user simply refuses to switch to anything else. Moving right along. Section 2. Flawless financial health. The numbers behind the brand. Just look at this number, 29.8%. That is Pidilite's exceptional return on capital employed, or ROCE, for fiscal year 25. Now, to fully appreciate this, you kind of need to know that their weighted average cost of capital is roughly 12%. So what does this all mean? It means Pidilite is generating massive economic value, just massively exceeding what it costs them to actually fund their operations. And get this, they've maintained this kind of insane value creation for an entire decade. And they're pulling off these returns while operating as a virtually debt-free cash machine. This incredible 0.05x debt-to-equity ratio right here, that shows us their growth is funded entirely by their own operations, not by borrowing. They have practically zero debt service risk. None. All right, time to play detective. Section 3, passing the forensic tests, a clean bill of health. So we're rigorously testing the balance sheet for any hidden red flags. Let's just rapid fire through these forensic results because they are seriously impressive. The Piotrowski F-score, which measures overall financial health, comes in at a strong 7 out of 9. The Altman Z-score, which tests for bankruptcy risk, is a massive 23.0, putting them deep in the safe zone. And the Benish M-score sits cleanly at negative 2.87. The takeaway? Pidilite shows absolutely zero signs of financial distress or accounting shenanigans. For our beginners out there, let's calmly define that last metric real quick. The Benish M-score is just a mathematical model using 8 financial ratios to spot if a company has manipulated its earnings. Basically, a score below negative 2.22 means you're a highly unlikely manipulator. So, Pidilite hitting negative 2.87? That definitively proves their earnings are genuine and totally backed by cold, hard cash flow. But it's not all sunshine. Section 4, the raw material threat, finding the villain. Every good story's got to have a villain, right? Now, what's really interesting about this is asking, what justifies a massive 63.2 times price to earnings ratio? I mean, sure, it's technically the cheapest the stock has been in 8 years, but that is still a steep premium compared to the broader sector. At 63 times earnings, the market is leaving absolutely zero margin for error. If they slip up even a bit, the stock is going to get punished. Which brings us to the actual threat here. Let's translate some industry jargon so you know exactly what's putting those margins at risk. Say hello to VAM, or vinyl acetate monomer. This is a globally priced petrochemical raw material, and it is fundamentally essential for making adhesives.
Because it's a petrochemical, it is highly, highly vulnerable to global supply shocks and geopolitics. At the end of the day, VAM dictates Pidilite's profit margins, period.
And right now, that cost is spiraling. The analysis warns that VAM costs have surged 40 to 50% in fiscal year 27, mainly due to geopolitical tensions in West Asia. To defend their margins, management actually just rolled out massive 11 to 13% price hikes across their product lines. This is going to seriously test consumer demand elasticity. I mean, are buyers going to accept these higher prices, or will volume growth just completely stall out? Let's look at what this means for valuation. Section 5, 3 Scenario Valuation, Price versus Value. Let's just impartially lay out the math here. The source analysis gives us 3 specific price targets based on how this whole raw material situation plays out, compared to the current price of 1,468 rupees. If the VAM crisis absolutely crushes demand, the bear case points to 1,180. If those price hikes successfully absorb the cost without losing customers, the base case targets 1820. And if costs miraculously normalize while growth accelerates, the bull case aims for 2250. So impartially speaking, this sets up a 2.2x risk-reward asymmetry, which basically means the calculated upside mathematically outweighs the downside risk. Okay, bringing it all home. Section 6, the final verdict, quality versus price. Let's bring all this fundamental detective work together. Really, it comes down to balancing 2 opposing forces. On one hand, you have this unassailable quality moat, 70% market share, virtually 0 debt, and nearly a 30% ROCE. But you absolutely have to weigh that against the current risks, a super demanding 63x PE multiple combined with a scary 50% spike in raw material costs. Balancing all of that out, the stress-free analysis gives Pidilite a score of 84 out of 100. That results in an accumulate verdict if you're looking at a 2 to 3 year horizon. It's an exceptional, high-quality compounder that's just navigating a very real near-term storm. Before we wrap up, a quick but important disclaimer. The analysis shared in this explainer is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. So I'll leave you with this one final thought. Can Pidilite's legendary brand loyalty actually withstand a massive 13% price hike, or will the crushing weight of raw material costs finally crack the Fevicol bond? I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below and it might be the subject of my next explainer. Thank you for watching and keep your investing stress-free.